lifting that tech has done, specifically in the S&P 500. If you look at this chart here, you see that tech is at the very top, really supporting the first quarter for the S&P. The big question, Scar, is whether earnings are going to support that rally in tech moving forward.
Right, that's a really good point. And the takeaway so far from the big bank earnings that we've gotten and some of the regional bank earnings that we've gotten is that it's okay, things are all right, nothing's too terrible, but it also doesn't necessarily inspire a lot of confidence as we head towards the second half of the year. So you add it all up, and Jay Pulaski over at TPW, he describes the current mood as crunch time in the markets for the Fed, for other central banks, for the S&P, because it's clearly stuck in this trading range. You can see it's going nowhere at the moment. The Dow also going nowhere. The Nasdaq moving up marginally higher, and the Russell also moving up marginally higher.
And if you look at the sector level, it's an even split. You have 11 sectors, 6 of them are in the green, 5 in the red. Let's look at what is gaining right now. It's consumer discretionary. That sector actually putting together a pretty good rally here, up 1.3%. Had to double check that. Staples, though, that's sort of that defensive tilt to this market. You can see rallying about 0.8%. Healthcare, like Carol mentioned. Then you take a look at the downside. It's materials, it's energy, and it's financials after the doozy of the week that we just had, Scarlett.
Absolutely.
That's a technical term, right? Doozy?
Doozy, oh yeah.
How do you quantify
that?
All right, let's take a look at some of the big movers here. Procter & Gamble, the best performer in the Dow, at one point rose as much as 4.8%, the biggest advance since March 2020, boosting its sales outlook thanks to higher prices and solid demand, but it did not raise its profit outlook, interestingly enough. SLB, or Schlumberger, as it used to be known as, the oil services company, saw its cash flow disappoint the market, and that's a reason why the stock is off by almost 5%, even as it gave a bullish outlook on spending on oil exploration for years to come. And Tesla has been all over the place, right? It plunged about 10% yesterday. It rebounded today as Elon Musk suggested, actually he announced he's increasing prices of the high-end model of Model S and Model X after yesterday saying that he was cutting prices and will continue to cut prices on the more high-volume models.
Oh,
That's a lot.
Bring it up with Matt Miller, though, and he will be like, listen, guys, they're raising prices on the higher end. They're cutting prices on the lower end to get to the mass market. He just goes wild because he says it's a strategy. And that Tesla's not alone in doing this.
Sacrifice your margins, increase market share. I heard the case from him.
All right, and of course, CSX, also the railroad company, gaining more than 3%. Analysts raising their price target after its first quarter EPS beat analyst estimates. I got to go back to the tight trading range for a moment here, this lack of momentum that we've been talking about. This is a pretty good indication. When the S&P 500 closed up, 54 points, 1.3% last Thursday, that was actually the biggest move at the close to the upside or downside this month. So when you add it all up, the S&P is seeing its smallest monthly move in years, 99 points. And what's interesting is this is after the index recorded back-to-back quarters of 7% gains. It feels like, guys, that there is a certain bearishness hanging over everyone. The latest Bank of America Global Fund Manager survey revealed that people are overweight in bonds, are definitely positioned defensively. First quarter bank earnings have not really changed the mood or anything, and analysts are not rushing to meaningfully slash upcoming earnings estimates. People are just kind of stuck in place.
You know what's not stuck? Fed and the Fed messaging. It feels like, I mean, I know there's been some separation of thought maybe to some extent, but I feel like we heard from the Federal Reserve Governor, Michelle Baumann. She made some very brief comments, an opening statement at the Fed's first in-person Fed Listens event since 2019. She really kind of got to the point very briefly in her comments and really reminding us what matters to the Federal Reserve. Here's what she had to say.
The Fed has been focused on lowering inflation, which is absolutely essential if we want to support a growing economy and rising incomes.
All right, so it's all about lowering inflation. So that means, I mean, we can expect this, right? We know, and I think we all kind of know what's going to happen at that May meeting, even though there's maybe been a little bit of debate maybe among the Fed speakers. But nonetheless, I think when we come down to it, Maddie, we have to remember that it's going to be at least another rate increase, and then we're probably going to stay there for a while.
Yeah, at least another 25 basis points seems to be the consensus here. But if you look at the Fed Beige Book from this week, it showed that our concern about that credit tightness for small banks, it's not unfounded, right? And you see that that continues to be the case. I think it'll be really interesting going ahead to Monday, hearing from First Republic's earnings, whether or not we get more or less evidence about the stressors on regional banks.
And Maddie, I'm glad you brought up the beige book because I thought that was really important. Usually I sort of just breeze past it, but the beige book this time around, it was really interesting that it did paint that picture, that worry among businesses about this credit crunch. And it's a good reminder that what we're seeing in the market is pretty short term in terms of what the worry warts are. But when you think about the psychology of lending at these banks, that's going to take a long time to filter through.
Right. People are talking about the lag effect of rate hikes. It can take up to a year, and we've only started to see it come to fruition at this point. So there's going to be a lot more messiness in the second half of the year. But at that point, of course, equity investors are looking ahead, right? That's what you do. You look past the moment and anticipate what's to come.
I'm just going to say, not messy, those PMI numbers. Maybe we'll talk about that when we come back. We will be back in less than an hour's time. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We're going to count you down at the close, wrap up the Friday trading session, really, and wrap up the week. Join us at 4. Bit messy out there, that's for sure. And it's really funny, like we get a day where we get some things that point to things being better, stronger, calmer, and then we get another day, or maybe all in the same day, of things saying something differently. Today is the last day, though, before Fed members go into a blackout period ahead of the next FOMC meeting in May. It's just around the corner. Consensus building around one more hike, followed by a pause. Pausing could be made easier, though, and this is something, Maddie, you just talked about, if tighter credit helps the Fed to cool inflation. Flip side is a corporate credit crunch that may be just getting started that could end up dragging down the U.S. economy. So it's what investors are constantly debating in their heads and probably explains this tight trading range, certainly, that we're seeing. So let's get more on this debate, this discussion. With us is Bloomberg News economics editor Molly Smith, along with Bloomberg News markets editor Abigail Doolittle, both in our Bloomberg Interactive Brokers studio. Molly, I want to start with you. Your story front and center. We all read it this morning. We're like, we got to talk about this. The credit crunch. Where are we? How bad is it? And who's really being impacted?
So I think we can definitely say that, as we said in the story, like worst case scenario seems to have been avoided. Like the financial system, as a lot of people have been saying, at the top ranks of the government and the banking heads themselves, financial system is very safe, very steady. But there are some of these pockets within small business, within distressed companies who are already probably struggling to borrow money, within some consumers who are also probably a bit stretched, that they're just feeling it that much more. So it is a little bit tough to discern what was already in place because of inflation, because of rising interest rates, and now you've just got this additional stress from the banking system on top of it.
That's a good point, right? We don't know how much was kind of already building versus what then happened as a result of the collapse of the banks.
And do we know yet how much of this is specifically hurting those small businesses versus bigger?
So the best gauge of that we probably got with the small business report from the National Federation of Independent Business, and looking at the credit conditions on that, some of the businesses saying that it's harder now to get a loan than it was 3 months ago. The share of that now highest in a decade, so that was very concerning. Also, those paying higher interest rates going back quite some time. So they're definitely feeling it. But we did talk to several bankers who cater to small and mid-sized businesses, and it was a bit of a mixed bag. Like, a lot of this really does depend where in the country you are. Obviously, in California, where a lot of the stress is centered, like that's a much different picture than maybe in the Midwest. So it really does depend who you're talking to.
I was just prepping for a real estate panel at Milken and talking with big players in the real estate place, and they're like, remember, it's all different depending on what you're looking at, what type of real estate, and where geographically. Abigail, come on in on this and the market perspective of what Molly is talking about. Are we seeing this play out, in the financial markets? I just pulled up the Russell to look at the small caps. I mean, they're definitely lagging their broader cap brethren, but how would you see it, or what do you see?
I think that investors are a little bit puzzled because we really, today at least, don't have markets moving, and on the week we don't have markets moving. In terms of real estate and the idea of credit crunch, I think most investor strategists that I'm listening to have heard are saying that there's pockets of credit turmoil, that it's very specific, similar to what you're talking about in terms of these experts at the Milken panel. But a broad 2008 type event. And I see Molly shaking her head, so that's good. I feel better
a little
about
boring, right? At this point,
yeah,
dare I?
It really, I hate to use that word idiosyncratic that some of us may never have even used ahead of the SVB banking crisis. And now it's the whole thing. But, clearly there are some banks that made poor risk choices. Their liquidity was questionable, but it's not across the board. But because of the questions and the fallout, it's affecting some of the perception. I mean, perception is everything. I mean, some of these banks, the funny thing is, on the week, First Republic's up ahead of their report next week. M&T put up a great quarter. It's up on the week. So it's kind of surprising. I think that it reminds me, and even that week, it reminded me then of Volmageddon. I think we'll be talking about it for a decade, but I think that it was kind of like one and done. It was very violent at the time and painful, and now it's sort of not even showing.
Having said that, I want to stay with Abigail for a moment, because one of the other stories that we knew we wanted to get to, and I feel like it fits in, is I know you do, because we've been talking so much.
I have a crystal ball.
We were talking so much about the complacency in the market as measured by the VIX. It just didn't make sense if you do it against the backdrop of the bank collapses and so on and so forth. And so maybe they tweaked it a little bit.
Yeah, well, it's
our new tool.
It's so interesting. So yes, the new tool is coming out on Monday, and it's going to be one of these. It's going to be a VIX based on these one-day options. Now, there's so many different ways to tackle this, but one I would like to say is the VIX is not the only vol instrument out there. The SIBO has a ton of volatility indexes. They have the 3-a-month. They have the VVIX, which is the VIX of the VIX. They have the SKU. So this is just one more. But because these one-day options are getting so much attention right now, the idea of this new VIX, it's getting a lot of attention. I mean, Steve Sosnick of Interactive Brokers, who frequently joins us on Options Insight, and I was speaking to earlier today, he's saying, it's a speculative tool. Alon Rosen over at Oppenheimer is saying this is a sign of just how speculative things are right now. But Steve Sosnick said he understands why SIBO is doing this. It's not so much for investors. It's a cash cow. These vol indexes make them a lot of money, and they're seeing so much trading in the one-day options. Most of the institutional investors are very speculative about or skeptical about it, saying that this is the height of speculation. Now, Dan Curtis, our markets,
I love that take on it, right? Create this new investment. Okay, go ahead.
Yes, and he's saying, this is for retail investors. So of course the institutional investors really don't care. So
And also, how big of a win is it for retail investors that they've pushed SIBO to create a new VIX, basically?
Yes, but on the other hand, there's an article on the Bloomberg Terminal I just started, another great one by Lou Wang, saying that $385,000 has been lost. Day traders lose $358,000 per day gambling on zero-day options. So maybe they can use this VIX, this one-day VIX to hedge it. I don't know. It's going to be really interesting if, say, the VIX, which these institutional investors very much are standing by, stays at 16 or 17, and this thing spikes up to 50. Who knows? That could be the ultimate vol.
Right, exactly. So having said that, so here we are talking about the complacency that we've seen with the VIX at this point. Does that make sense, Molly, as you look at the economy and the business environment and your story?
Yeah, I mean, I know you were alluding to it before with the latest PMI figures that we got from S&P this morning.
Right?
Hey, look, no recession there. Looks great. Looks like the economy's doing great.
Well, is the scale dipped more in favor of doing well versus not?
I mean, it depends. What do you mean by doing well? For who? For the American people, for the Fed? I mean, it's a loaded question. But
well, that's fair.
Yeah.
There's still growth, though.
Sure.
There's still a tight labor market.
Of course.
Right?
Yeah.
And we still have some points showing, the housing market goes back and forth. We're
right,
seeing
and
activity.
what happens with all that when you have people like us who want to buy more things and then companies who are going to make those
Not
things?
me, I'm done. I'm done.
Okay, so Carol's done buying, but the rest of us out here have to go still buy things. And companies are like, hey, well, guess I can raise the price again, and there comes inflation once again. So that is the counterbalance to all of this that would be very concerning for the Fed.
And are we seeing in the data that the credit crunch is actually starting to push inflation down in a way that's going to be meaningful to the Fed?
That's what people would love to see, and I think it's too soon to say that that's happened yet. Right now, inflation is coming down very slowly. If anything, I like to say it's more moving sideways, and I think what policymakers are really they care about that core index, which excludes food and energy, because right now, especially, a lot of us like to look at those annual inflation figures, and you're seeing the annual now is going to come down a lot, a full percentage point each month. But that's because it's compared to this time last year. That's when Russia invaded Ukraine, energy prices spiked. So it looks great that way.
But remember
annual
where we
measure.
were, right?
So
Right,
month over
exactly.
month.
But that's why when you look at the core measure, which we look at for underlying inflation, it's running faster than the annual measure right now, and that's still no good.
All right, so next week, look ahead, right? We won't hear from Fed speakers because they're in the dark at this, they're not in the dark, but it's a blackout period. Sorry, Fed speakers, you're never in the dark. But we have GDP, we have income and spending. What do you think investors, amid that tech earnings backdrop, what are you going to be focusing on?
I'm actually most looking forward to, I don't know if looking forward is the right way, but I am looking at least the employment cost index. So that's another big one that comes out on Friday. And that is, it's a broad measure of wages and benefits. So it comes out quarterly. And that one has really emerged as like a big indicator that the Fed looks at as far as like this wage debate, how much are wages fueling inflation.
And measures exactly what?
It's looking at, like it takes into account all different kinds of like salaries, compensation, bonuses, like a lot of different measures and benefits too. So really just like full pay packages, whereas like some other pay measures are really more focused on like the actual money that you are paid. So this is a little bit more comprehensive and something that right now is running well above what would be consistent with 2% inflation.
Wage price spiral insights.
Well, we don't want to say that. Let's not manifest that. That would be very scary.
Yes, yes.
But
20,
it's
25
not happened
seconds.
yet.
Among the Fed speakers, the most recent, who was the most important that you think we should keep in mind? Is that fair? Or was it?
I feel like a lot of them right now, I mean, there's, Bullard who's going to be Bullard and charge away, and then, let's keep hiking all day long. The others, I think, are a little bit more balanced and saying, like, let's really assess how much the banking stress is helping us out here.
Yeah, and having said that, you take that out of the equation, I think it's very clear. Fed says we're fighting inflation, and we still have inflation.
Yeah, I still think they're probably going to go in May, for
I
sure.
think so too. All right, Molly Smith, have a great weekend. Economics editor at Bloomberg News in our Interactive Brokers studio. Abigail Doolittle, our thanks to her as well, markets reporter at Bloomberg News. You're listening and watching Bloomberg Business Week, and this is Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Yes, 3:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are wavering right now in the red, but they have been fluctuating between losses and gains amid mixed corporate earnings. Also, traders are sifting through the latest data for clues about the outlook on inflation. The 10-year yield, 3.56%, with the 2-year, 4.18%. Again, little change in the S&P, down now by 1 point. NASDAQ Composite Index also lower by 1 point. The Dow right now down 18. That's a decline of less than 0.1%. Spot gold, $19.81 the ounce. Gold is down 1.2%. West Texas Intermediate crude, $77.72 a barrel, up by about 0.4%. Former Treasury Secretary Larry Summers is rejecting speculation that the dollar is rapidly losing its dominance in the global economy and highlighted China's detractions in providing an alternative reserve currency. He spoke with Bloomberg's David Weston on Wall Street Week.
Is anybody who's looking for political stability, who's looking for predictability, who's looking for the nonpartisan, objective adjudication of their claims, are they really going to hold large quantities of assets in RMB?
To hear the full interview with Larry Summers, tune into Bloomberg Wall Street Week tonight, 6 o'clock Wall Street time, right here on Bloomberg Radio. Recapping S&P lower by a point, I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, you are listening and watching Bloomberg Business Week. Carol Massar along with Maddie Mills. And just 2 days after the latest price cuts from Tesla, the EV maker, as you know, we've been talking about it here at Bloomberg, raising prices in the U.S. on 2 different models, this time the Model S and Model X vehicles. And this is coming one day after Tesla stock took a dive, that was yesterday, following concerns about cutting prices that led to a cut in margins in its latest earnings release. We got the details on that. Operating margins slipping to 11.4%, a 2-year low. I feel like the strategy at Tesla, raising prices, cutting prices, everything Elon, is one of the most unique Harvard Business School case studies of all time. So let's get to one of the most read stories on the Bloomberg that kind of wraps it all together, and it is about how Tesla has entered a new era. Joining us with more Bloomberg News Global car czar Craig Trudell, joining us on the phone from London. Craig, thank you so much. I know it's later there in London, so I appreciate getting a chance to talk with you. So the new era has to do with Tesla and Elon's moving on pricing. Tell us about this new era and what it means.
Yeah, so I think, it's been over 10 years now, right, since the Model S launched. And that was a car that really sort of shook things up for the auto industry. No one really believed that you could make a compelling electric car and make any money selling it, right? And Tesla has absolutely proven the industry wrong in that respect. And they tried to move into a new era where they would sell not only compelling electric cars, but sell them for the mass market. And they really struggled to pull that off. I think first it was because if they were going to really stick to that, they were going to go out of business. And so they really were not able to hit the $35,000 price point that Elon Musk long promised. And then conveniently, the last few years, we've seen Tesla and the whole industry in this really sort of unprecedented situation of no one was making as many cars as they had demand for. And so, they could sort of cover for the fact that their mission was something they were having trouble accomplishing because everybody was jacking up prices, right? I think we now are sort of seeing them get back to what Musk wanted to do all along, which was sell a ton of electric cars. And it's really, really hard to do that at, $40,000 plus, right? And so we're seeing the Model 3 come back below that threshold. It looks like the Model Y is going to be there in no time because we've seen it fall 29% in roughly 3 months. And we've just never seen anything like that before.
Is there a bottom, Craig, for the Model Y specifically that you could tell us, a prediction on that?
I think I would reckon that, in that mid $30,000 range is probably where we end up seeing it. And, we're already seeing, in China in particular, because they're, they've got a sort of lower cost base there. They've got cheaper batteries. They've just, I think another part of this whole equation, right, is they have so much capacity that they've added just in the last year. They went from having 2 plants, one in California and one in Shanghai, to, in the matter of a few weeks, opening one near Berlin and one in Austin, Texas. And so, I think we're only just sort of starting to, get our minds around the fact that this is a company that has so added to its ability to make cars that's going to mean some significant changes in, the price it can command for them.
So is it a case of, Craig, and it's funny because Matt Miller came out of the studio and I was like, nobody's understanding, what Tesla's doing. Matt, of course, our car aficionado, along with you guys. But what's interesting is he's saying they're raising prices on their higher end where they make the best margins, lowering it on the lower end where they don't make their best margins, but maybe they make it up on volume. And by raising on the higher prices, they ultimately help kind of pay for really getting that cheaper model out there among, quote unquote, the masses. I mean, is that kind of the strategy?
It's I think this latest change that they've made to bump the Model S and X up is really hard to understand, as you alluded to in the intro. Mm-hmm. It doesn't make a whole lot of sense because those 2 models have just been on this steady march downward. And I think, it's hard for me sometimes. I feel like, do I have Bloomberg brain and I'm just paying too much attention to the markets? But it really feels to me like this may well have been a case of Tesla sort of realizing that they maybe kind of freaked investors out a little bit with how much they've cut prices and how much of an effect it's having on their margins. That maybe this was sort of throwing the markets a bone to say, we get it, we're going to cool it, and here's a little increase on models that, by the way, now are just like 2.5% of their total deliveries. So they're really sort of a rounding error. If it means, if raising the prices of those a little bit means a slowdown in orders, so be it. They're kind of, not very meaningful to the business at this point.
Interesting.
Yeah, it feels like they're kind of competing against themselves in that way. But who would you say is Tesla's real external competition, Craig?
Yeah, I mean, the S and the X models are were high before these recent little bumps up in price, right? You really have to pay close to $90,000 now for the Model S, and this is a car that again is 10, 11 years old, right? And so I think that sort of helps to sort of explain why they've brought the prices down so much. The fact that those models are a bit long in the tooth. They did make an effort a couple of years ago to at least update the interiors of them a little bit. That did seem to help, but sort of underneath and in the guts of the car, these are pretty old vehicles at this point. And those are competing with the likes of Mercedes and BMW, where and even higher end electric vehicles, the Porsches of the world, where I think a lot of consumers are more comfortable with build quality and sort of craftsmanship than they might be a Tesla.
Right, and a network, a network to take it to if something goes astray. Hey, so in your story, you say Tesla abandons Mercedes, or at least this is the headline on it. Tesla abandoning Mercedes battle to take on the likes of Ford. So this shift is meaning that Mercedes, you don't maybe need to be so worried. It's other automakers in this shift by Tesla?
Yeah, I think the luxury players can't totally sort of rest easy at this point, right? I think, we'll see at some point, although Lord knows when, a Tesla Roadster that will be another sort of a newer model that will, command these high prices and compete with the luxury players. But I think, by going into the, 30,000 or mid 30,000 range that Musk seems headed toward, that's really not where Mercedes and BMW tend to play, right? And Mercedes in particular is very drastically going in the other direction. Oleg Kalenius is really sort of making a push to move further up market, focus on AMG, focus on big money spinners like the G-Wagon, and he's very comfortable with that, meaning lower volume, but getting more value and commanding higher margins. So he's playing a very different game than Musk is.
Well, I have to say, Maddie just she IB'd me before she goes mid-30 for Tesla. Not so bad. I mean, it really is a lot more manageable, Craig, and it does necessarily, probably open up a lot more consumers for Tesla. Just got about 20 seconds left here.
Yeah, absolutely. I think it's just a question for me of, what happens to the sort of brand value and sort of cachet of Tesla. And whether Musk ends up sort of regretting shooting himself in the foot a little bit, moving so quickly.
Yeah, I don't know. Yeah, I was trying to think, is it like Apple, like who does have a little bit of a range, but they're pretty expensive, any kind of Apple device. Craig, good stuff. Thank you so much. Really appreciate it. Have a great weekend. Bloomberg News, Global Car Czar, Greg Trudell joining us on the phone from London. We will see. I mean, we talk about their first mover advantage. He has been so aggressively building out his global network, right? That I really do feel like it puts him ahead of a lot of other players, but I guess we'll see over time.
The Apple comparison is a great one, though. I would definitely read a piece on which companies have changed prices the most.
Right? Because it's just been, Apple's been another interesting business case study. All right, let's get to world and national news. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Carol. On this, the eve of Earth Day, President Biden is taking steps to address the disproportionate impact that climate change is having on minority communities. Today, he signed an executive order to tackle those inequities.
This executive order creates a new Office of Environmental Justice and a new role for the Chief Environmental Justice Officer. They're going to coordinate. They will coordinate all our efforts across government to make sure we're delivering the greatest possible benefits to people's lives.
Biden says the office will focus on communities that are disadvantaged because of racial discrimination or poverty, and where risks for diseases like asthma and cancer are greater because of lower environmental standards. The Supreme Court is expected to issue its ruling on access to a commonly used abortion pill before the end of the day. The court imposed a temporary stay on a Texas federal judge's ruling to halt production and distribution of mifepristone. The judge says there are questions about the FDA approval process. The drug was originally approved in 2000 and has been used by over 5 million women since then. Republican Congresswoman Nancy Mace of South Carolina says the party's position on abortion could end up hurting them with voters.
Many pro-life people still don't want the heavy hand of government making that decision for women and girls. We will not win the popular vote in 24 if we continue down this path of extremism.
Congresswoman Nancy Mace, the Biden administration argues tossing the FDA approval would result in regulatory chaos. The NFL is suspending 5 players for violating the league's gambling policy. Detroit Lions wide receiver Quintez Cephas and safety C.J. Moore, as well as Washington Commanders defensive end Shaka Toney, were suspended indefinitely. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. 20 minutes to go ahead of the closing bell. We've got stocks fluctuating. Very little movement today for the Dow, the S&P, and NASDAQ. So let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are wavering as investors digest another batch of corporate earnings. The Dow is up just 15 points. S&P little change, with the NASDAQ gaining less than 5 points. The U.S. 10-year yield is at 3.57%, and small caps are down 5. 6 of the 11 main S&P sectors are trading higher, led by gains in consumer discretionary and staples, while materials and energy are the worst performers. NASDAQ biotechs rise 50 points, transports drop 40, semis are down 30 points, while the VIX is lower by 2.5%. Leaders in the Dow, Procter & Gamble, Disney, and Merck, while Intel, Dow Inc., and Boeing are the worst performers. After earnings, HCA Health rallied to a record after boosting its full-year view. P&G rose after upping its sales outlook after beating estimates, while Schlumberger fell 5% after disappointing cash flow update. In other news, Lyft rallied after unveiling plans to cut as much as 30% of its staff. Wrapping things up, lithium miners SQM and Albemarle fell after Chile's plans to nationalize the industry. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
All right, we thank you very much, Bailey Lipschultz. Have a great weekend, and to hear live breaking news over your Bloomberg, type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 17 and a half minutes left in today's trading session. Getting ready to wrap up that Friday trade and the trade for the week. Carol Master along with Madison Mills, live in our Bloomberg Interactive Brokers studio on YouTube on Bloomberg Originals. Want to get to our Drive to the Close. Anupam Damani is head of international and emerging markets debt at Nuveen. They've got about $1.1 trillion in assets under management, so they get to see an awful lot when it comes to investor thinking. She is with us via Zoom in New York City. Anupam, so nice to have you here with Maddie and myself. You know, I would love to first just start, though, with the big picture from you in terms of what we are seeing, especially when it comes to the emerging market economies. We got updates on growth, global growth and activity, and concerns from the IMF and World Bank just last week. How do you see it? Where are we seeing strength? Where are we seeing weakness? And as a result, we'll get into some of the opportunities.
Thanks for having me, Carol and Madison. Yes, emerging markets, right? So I think the growth differential is expected to outpace developed markets growth both this year as well as going into next year. And although IMF downgraded both developed market and emerging markets growth, I think the downgrade was much more stark in developed markets. So the differential is going to be about 2.5% in favor of emerging markets this year, which only expands going into next year. And historically, if you look at that differential, that has been a driver for inflows into the asset class. Additionally, I would say both cyclically and structurally, emerging markets is quite under-owned compared to historical levels. And there's pretty limited net supply in both the sovereign hard currency market as well almost a negative net supply in the corporate market. So the technicals bode also quite well for the asset class.
Can you talk a little bit about specifics here? I know you have a lot to talk about, but the emerging market sector can mean so many different things. Is there a specific area or currency that you're looking at that's particularly notable to you as a potential for upside?
Yeah, no, you're totally right. EM is such a diverse opportunity set. I like to always say it's not a monolithic asset class. It's a very heterogeneous mix of countries with different drivers of growth. We can choose between sovereigns, corporates in hard currency, which is US dollar denominated, as well as local currency opportunities. And there are as many as 70 countries, right, that you can actually pick from. So some of the countries that we are focused on, I like to sort of divide them into three groupings. One is stable to improving macro stories such as Mexico and India, right? And these both benefit also from this new paradigm in the geopolitical space of near-shoring or friend-shoring, so to speak. They have positive demographic dividend, they're improving growth, inflation pictures, and really they have a whole host of corporates, a very dynamic and a robust corporate sector for us to choose from. And oftentimes many of these companies have lower leverage and higher net cash flow or are net cash flow positive compared to some of the developed market peers, and yet they offer a higher sort of yield advantage over the developed market counterparts. So that's one of the groups. The other group that we like is really, thinking about more reformers, countries that are in an upward rating trajectory, such as Serbia, where we think there's improved fiscal dynamics and there's a strong FDI pipeline. So that's another sort of grouping of countries that we do like.
Hey, Anupam, can we go back to what you said about Mexico and India, nearshoring, friendshoring? I'm assuming, does some of that play have to do with the tensions we're seeing between the U.S. and China and, the pushback that we've seen over the last couple of years? It feels like increasingly against globalization. And then as a result, something like Mexico certainly benefits by its proximity to the United States. India as another possibility of a lower labor workforce, at least lower cost to some extent, and just having lots of people where they can do it.
Absolutely. I think you hit it on the spot. Post the pandemic and then further exacerbated by the Russia-Ukraine conflict, right? We're sitting in a geopolitical landscape that many countries are very focused on making their supply chains quite resilient and also in general just diversifying their supply chains. And for the US, it's a little bit more looking at it from a similar values perspective. So they are thinking about deepening economic integration with sort of dependable trading partners to diversify away from nations that pose geopolitical and security risks to their supply chains. And I think that's where India comes in, even though it's a lot farther from the US. But, Mexico clearly closer to home, and already benefits with some of the trading links and the trade framework that we have in place with them.
So what does it mean for China as an emerging market? Although I always feel mixed. It is an emerging market, but it's so much more complex. I feel like in terms of opportunities there, is it even on your radar?
Yes. So I think the way to think about it is, look, the China reopening, as chaotic and messy as it has been, it is surely and slowly the recovery is gaining momentum. Some of the recent indicators that came out also suggested so much that the economic rebound is well in place. I think we are trying to, rather than play just through China, because all investments in China almost have to be looked at from the U.S. security lens, being a U.S.-based investor here. And we rather play China through the outbound tourism. Mm-hmm. So countries like, Singapore, Thailand, Malaysia may benefit as the Chinese start to travel outside again. It's going to be more consumption driven this time, the recovery. And so really thinking about the countries that export in terms of manufacturing exports or electronics that would benefit from that reopening, such as Korea or Taiwan. And then finally, Chinese with the reopening consuming more commodities. And so that's the other channel through commodities, mm-hmm. which impacts and positively a lot of the Latin American economies.
Well, really appreciate you weighing in. Have a great weekend. Anupam Damani, she's head of international and emerging markets debt over at Nuveen, as we mentioned earlier, about $1.1 trillion in assets under management, joining us via Zoom from New York City. Interesting perspective and reminding that, investors in terms of diversification, thinking not only different sectors, but really thinking globally and different types of asset classes.
And such a good point, Carol, that it's so fascinating that we continue to call China an emerging market. It feels like its own category of market.
It is, and yeah, it's just an interesting study all on its own. We're going to talk a little bit later about U.S.-China relations. We'll get to that in just a moment, right here on Bloomberg Radio.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. Battered regional banks are getting a vote of confidence from the one-time king of the bond world. In his investment outlook, Bill Gross, the former chief investment officer of PIMCO, says he is buying stocks including Western Alliance Bancorp, Synovus Financial, and PacWest Corp, as well as the SPDR S&P Regional Banking ETF. Right now, Western Alliance up 2.5%. Synovus Financial is down by 1%. PacWest Bancorp up 0.5%, and the S&P SPDR Regional ETF is down 1.4%. 2 days after price cuts, now word of a price increase on some models at Tesla. And with more on the story, here's Bloomberg's John Tucker.
Charlie, according to the company's website, Tesla bumped up each variant of its high-end models by $2,500, raising the cost of the sedan and sport utility vehicle by 2 to 3%. The Model S and X now start at $87,490 and $97,490, respectively. These increases still leave the vehicles cheaper than they were at the end of the first quarter when price cuts across Tesla's lineup squeezed profit margins. The adjustments come 2 days after Tesla lowered prices on much of their higher volume Model Y SUV and Model 3 sedans for the second time this month. Charlie?
And that's Bloomberg's John Tucker reporting. Lyft shares right now are up 6.1% after saying they're going to cut 1,200 or more jobs. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session. Carol Massar along with Maddie Mills live in our Bloomberg Interactive Brokers studio on YouTube on Bloomberg Originals. LVMH. A lot of talk and conversations about this company. I mean, a lot of the luxury space has been doing just fine, I should say. Just fine. I mean, there's a great story on the Bloomberg today about luxury fortunes jumping $93 billion in demand boom for Hermes, Dior. So we're talking about all of these companies, LVMH. I mean, Bernard Arnault, he's the world's richest person. He built LVMH into a 75-brand fashion juggernaut, including Christian Dior, Tiffany, Moet Chandon, Champagne, you name it. And we have a story, and I feel like there's been a lot of news about the luxury space. We have a story about how they're, LVMH specifically, what they're doing, some maneuvering.
Yeah, they're shifting out of Hong Kong as Chinese shoppers are continuing to switch to shopping at home. And they want to focus more of their investment on kind of burgeoning marketplaces like Shanghai, as Hong Kong, again, continues to kind of lose its relevance in the Greater China region. And that was a Bloomberg scoop with people familiar with the matter with LVMH. But it's interesting and kind of part of the broader story about China's reopening, not necessarily looking exactly like what we thought it would.
No, but not abandoning Asia, but just shifting, right, in terms of their presence, because we constantly talk about when it comes to a lot of the luxury retailers, the luxury sector, that in terms of the China reopening, they have seen a bump up when it comes to demand in their goods. And especially it has to do with, you know, where we're seeing wealth accumulation specifically, and Asia has certainly been a big creator of billionaires and billionaires.
Yeah, and it's, I mean, just talking to my friends who were living in Hong Kong, who are on some of our teams, I mean, it's a very different Hong Kong than it was pre-COVID. And I think even as China's moved to reopen, the kind of aftershocks of that are still impacting consumers. The behavior has just really changed, and I think the fight back to whatever normalcy, quote unquote, is going to be a longer road ahead.
Yeah, and it's interesting. It does say for LVMH that the recovery has been much slower in Hong Kong than elsewhere in Greater China, according to those in the know. Anyway, LVMH shares, they are up again in today's trade. We're talking about the ADRs. Speaking of the trade, time to wrap up today's trading day. Heading over to our TV colleagues because Beyond the Bell starts right now.
Change market as we head towards the close. As we get you to the closing bell, full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We've got about 2 minutes to the close from the end of the trading day and week. I'm Scarlett Fu here with Katie Greifeld as we count you down to the closing bell. Here to help us take you beyond the bell with the global simulcast, Carol Massar and Madison Mills. And in doing so, of course, we bring together our Bloomberg television, radio, and YouTube audiences worldwide as we parse through the most crucial moments of the trading day. What was crucial about today's trading day, Carol? I've struggled to find a pivotal point in today's trading day, at least.
I don't know that there's anything crucial. I think what's interesting, I keep thinking about the strong economic news. We did see that 2-year go up right to 4.2%. I think it's back below that just a hair. So I don't know. I think what's crucial is the tight trading range, because it's like we're waiting for something to make us do something differently.
Yeah, and I think perhaps
Sorry,
what's
I don't have
crucial.
anything better.
I mean,
pretty good.
The only thing, okay, I mean, Katie, I'm going to need you to give me feedback on this. Can we look at the VIX heading closer to 16? Is that confusing to people? Is it just another sign that we need a new one that's coming in on Monday from SIBO? What is that about?
Well, that's the thing. We are getting a new one. Maddie, I think you did a great job, by the way. It's going to be interesting to see that new version of the VIX. Of course, we've been spending a lot of time talking about zero DTE options. Now we're going to have another way to look at it.
You know, it just feels like there's a lot of bearishness in the market, and people keep thinking there's a recession coming, inflation remains elevated, the Fed is not going to cut rates anytime soon, yet we don't really see analysts cutting their earnings estimates going forward in a meaningful way. So something's got to give, and I'm not sure which way it's going to go and when that's going to happen.
Yeah, I guess we'll see. You know, I really do think all those tech earnings, which we'll get into shortly, could be a big mover in sentiment potentially next week, Scarlett.
Yeah, all right, well, here we go. There's a closing bell. We're about 3 seconds away, and right now it looks like we are going to end with modest gains for the S&P, Dow, and NASDAQ, along with the Russell 2000. Everything within this range of a gain of 0.1%. And in terms of volume, I think to no one's surprise, it is below average. About 8.9, ticking up to 9.1 billion shares traded in total. And of course, that's not too surprising given the muted moves that we've been seeing.
I gotta say, guys, you talked about this earlier, and I'm just looking at some of the top performers in the S&P 500 this week. First Republic is on that list. It's up more than 8% for the week, another 2.6% higher in today's session, still down almost 90% for the year. And we know we're going to get earnings next week, but I find that fascinating how kind of the mood has shifted dramatically when it comes to the regionals.
That is fascinating. I cannot wait for Monday. But before we get there, let's take a look at some of the industry groups. Pretty even split on this very strange, completely unchanged day. Look at what did do well was household products. A lot of that coming from P&G, for example. And then you look down the list, you have retail names, telecom, pharma, the list goes on. But again, pretty muted movements once we start to get to the middle of the pack. And then we look at what didn't do too well, Carol. It's insurance, it's materials, and it's the banks, that industry group falling about 1% after just a doozy.
All right, so let's get to some of the individual gainers in today's session. HCA Healthcare, it has been number one, number two, top in the S&P 500, I think settling in at the number two spot, up well off its highs of the day. It was up almost 9% today, but finishing still with a gain of about 3.8%. It did hit a record high today. The hospital firm boosting its earnings per share and revenue forecast for the full year, and it did lead that overall hospital equity play higher in the Friday trade. CSX, also an outperformer. It was number one gainer in the NASDAQ 100. First quarter EPS beating analyst estimates, revenue boosted by the company's merchandise and coal businesses. And then as a result of CSX, their results, analysts over at Morgan Stanley and Citi raising their price targets on the stock. So CSX up about 3.3%. And then I want to take you to Amazon. This was, we saw a top gainer in the NASDAQ 100, top in the S&P 500 earlier today, rallying ahead of earnings next week. One thing of note, JP Morgan is saying Amazon remains the firm's best internet idea into their first quarter reports and results. Stock is up about 30% year to date. So I thought that was interesting ahead of earnings next week, Maddie.
Yeah, well, I'm going to go back to the financials discussion that we've been having, starting with Regions Financial falling at 2.8% on the close. That's after missing on profits. Deposits were in line with expectations, but we still did see a decline there, and you're seeing the markets reacting to that. They're also saying that their loan losses were higher, and of course, this comes as we're all awaiting those First Republic earnings coming in on Monday to get the fuller narrative when it comes to the credit discussion that we've all been having. I also want to take a look ahead to tech. If we look at Seagate, actually, this was the third worst performer on the S&P this week, down a little over 1% on the close here. They suffered their worst single-day stock decline in more than a year this week after a disappointing outlook on revenue. And this could be a broader indication of spending pullbacks from big names in the tech space, which are some of Seagate's biggest customers. This is a hard drive company primarily, so that could be an indicator as we head into next week. And then CDW, this is a company we wouldn't usually talk about, but this is the second time I'm bringing it up this week. This is the second worst performer on the S&P for the week. Again, the question is this an indicator here of a broader pullback in demand? That's what the company was blaming bad earnings on this week. So could this be a story that we continue to hear heading into next week as we get some of those bigger tech names?
And let's head over to the bond market. We saw a little bit of a sell-off, and I stress a little bit. If you take a look at what yields did on the day, you can see the 2-year yield up, 3-4 basis points. Same story if you go out the curve, the 10-year Treasury yield up 3 basis points as well. And then it gets less dramatic if you go further out the curve. And I mean, this is what normal looks like. I mean, I think about what we were talking about a month ago at this time. We were talking about double-digit moves. Not the case right now. It feels like a little bit of calm coming again as we await for those catalysts that we keep talking about.
Yeah, and I suppose one of the catalysts is more conviction in the idea that the Fed has a path and it's going to stick to it. Right now, we know that the Fed is likely to raise interest rates by 25 basis points in May, and the consensus seems to be one and done, and they'll wait to see how that all shakes out. You would think that more people gravitating to that idea would lead to some kind of relief rally in both the bond market and stock market, but we're not seeing that either. So it's really unclear as to whether big tech earnings will unlock that paralysis.
All right, that's my catalyst. I'm thinking about next week. First Republic on Monday, Alphabet Tuesday, Microsoft Tuesday, Meta Wednesday, Boeing Wednesday, Caterpillar and Amazon Thursday, and then you've got Chevron on Friday. OMG. I mean, I feel like we're just going to get, either some really, I don't know, will we get conviction? Will we get some good outlook? Will we get a new direction in the trade or a confirmation of kind of maybe things are really okay here? I don't know. I think it's a big one.
Yeah, and we're already seeing the market react positively to any news of layoffs at these tech companies. You were talking about Amazon earlier, Carol, with those Whole Foods layoffs announced earlier this week. That is being rewarded by markets, but I wonder to what extent we're going to see that impacting profit margins as we head into next week.
Don't forget, too, we've got a lot of economic data points coming up as well, including retail sales and, of course, the first read on first quarter GDP, including core PCE, which is the Fed's preferred gauge of inflation, along with many other data points on inflation. Remember, it's all about the totality of data, but at least we get more of a read and the last glimpses of what the economy looks like before they head into their FOMC policymaking decision.
And I mean, the big question on the inflation print is, does this change anything? Of course, we could get some huge surprise in any direction, then I look silly here, but you have to think the Fed has a pretty good overview of what the different inputs say at this point. And again, the tone from the top down, they really have not budged. Inflation fighting is still top of mind, and that was their final word as we head into this blackout period.
Molly Smith of our economics team here, we had her on earlier, and she said what she's really focusing on for the week. There is a lot of economic news, but she said the employment cost index, which really takes into a lot of different things, bonuses, salaries, and so on when it comes to wages and what we are paying workers. And we know that that is something that certainly the Fed has been thinking about, especially for that inflationary pressures.
Yeah, and Carol, we were talking about this with Molly earlier, but my big question on that data point was going to be, are we seeing any evidence of a wage price spiral, which I know is like the big negative buzz term here for the Fed, but I think that'll be a really key indicator to tell us whether or not we are seeing evidence of that.
And in fact, I think people have done some work in terms of the earnings conference calls and what executives are saying about a labor shortage. They're definitely not thinking that it's changed. It hasn't gotten to a point where it's tipped over, and they're still definitely concerned about keeping and retaining talent. So we haven't reached an inflection point, I guess is the way to put it.
Yeah, for sure. I mean, you think about the dual mandate again, it feels like Fed speakers have been very clear what the focus is. It's inflation. It hasn't shifted to maybe the outlook for economic growth, the labor market. I know that maybe we've seen some prints that have started to suggest maybe we could see a little bit of a crack, but I mean, overall, it's still extremely strong.
Here's an inflection point, another economic data point. New York City subway ridership hits a post-pandemic record of 4 million.
Oh,
hey.
People are coming into the office, or they're just going around?
They're not going to the office, Scarlett.
They're at least getting on the subway. A lot of them are jumping the turnstile, so I've seen that a lot.
They want to see the rats. It's like a free zoo.
The rats.
No one else does that?
Only the pizza-eating rats do we really enjoy. All right, guys, that is a wrap. That is our Friday wrap. Our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. You guys have a great weekend. We will see you all back here, same time, same place, on Monday.
All right, looking forward to it.
So I gotta say, a lot of on our minds, and we just, with our TV colleagues, Maddie, talking about Fed policy, talking about inflation concerns, a lot of stuff, and it all makes sense. But the other thing to layer on top of that is the U.S. and China tensions, which continue to boil hotter. Our team reporting that President Biden aims to sign an executive order in the coming weeks that will limit investment in key parts of China's economy by American businesses. This is according to people familiar with internal deliberations. And then they're trying to get G7 backing on this.
And meantime, Taiwanese officials have urged their American counterparts to tone down their rhetoric about the dangers of relying on chips made by Taiwan semiconductor manufacturing. We're talking about TSMC, all just really important, and it speaks to the kind of rolling back of globalization that we've continued to see. So we are going to get to it, covering this from all sides. We've got Bloomberg News foreign policy reporter Nick Wadhams with us on the phone from Washington, D.C. Nick, there's a lot going on here. Tell us what the latest is when it comes to the U.S.'s intended sort of messaging here this week.
Well, so, the big thing is that essentially for a while the U.S. has been saying, listen, we need to shift our supply chains to reduce all our vulnerabilities, around the world. COVID laid that bare, but also in the event of a Chinese invasion of Taiwan. And what that really has focused on is TSMC and the fact that the U.S. relies on the vast majority of its semiconductors with TSMC. So now, particularly Commerce Secretary Gina Raimondo has emphasized that the U.S. needs to do something about this. Now, what we're hearing is that Taiwan is saying, okay, hey, you guys, we get the point, cut it out. So they have wanted to do this balancing act themselves, where they want U.S. allies, and in some ways, have been accused of overstating the threat of a potential Chinese invasion. And then now they're saying, listen, dial it back a little bit. We don't like all this talk of the U.S. Reorienting its supply chains away from TSMC, because that really is the goose that lays the golden eggs for Taiwan's economy.
Nick, let me ask you, how worried and scared is the administration? How scared and worried are policymakers up on Capitol Hill or just other members of the administration when it comes to China and its intentions on Taiwan?
Well, it really depends on who you talk to and what their interests are. So we hear a lot of different things. When you go on the Hill, for example, and you talk to lawmakers, they are all over the map, but really China hawkishness is a bipartisan effort right now, and there's a lot of talk about the looming dangers of an invasion. One thing that really spooked folks was this claim made by a U.S. Official some months ago that China may have the intention of at least having the capability to invade Taiwan by 2027. But then we've heard some other things lately where it does look like the administration is trying to dial back some of that hawkishness, dare I say, panic. We had the Indo-PACOM leader, Admiral Aquino, testifying this week saying, listen, that 2027 date is a guessing game. We really don't know. And then CIA Director William Burns saying a couple weeks ago, we don't actually think they would intend to invade anytime soon. So, trying to sort through that is obviously, for Taiwan, a pretty existential thing. And there's just so many different folks saying so many different things. But really, the administration, it feels like, is trying to dial that back.
Are there, I guess I'm trying to, we hear a lot, right? And you guys do reporting and so on. What can we assume that there's a lot going on in terms of behind closed doors or phones and back channels between the U.S. and Taiwan, and maybe between U.S. and China as well?
Well, no question between the U.S. and Taiwan. As I said, we understand that Taiwan is really sort of back channeling both to the administration, but also through business groups trying to tell the administration to cool a little bit. And I should say, one of these interesting elements of this that tells you where the money flows are. Fund managers and stock analysts are still rate TSMC as a big buy. I think more than any time in its history. So there's still a lot of interest in pouring money into Taiwan. Back channeling on China, that's a very different thing. As far as we understand, there are some low-level contacts and even visits by U.S. officials to China. But the real big stuff where the issues and the big questions get decided, as far as we can tell, that's really ground to a halt. I mean, there may be lower level contacts at the State Department, but the DoD, for example, military to military contacts are really on ice right now, and that's something that the U.S. has lamented.
So, Nick, you talk about investor sentiment around TSMC. I want to talk about Buffett selling off $3.7 billion of TSMC stock. That's 86% of Berkshire's holdings. And he said that was specifically about those geopolitical concerns. What is worse news for Taiwan here? Is it federal government speak from the likes of Raimondo, or is it moves from Wall Street like Buffett selling off stock?
Well, it's a great question because, the Buffett thing was a bit of a bomb, and really, because he did very explicitly say, we think TSMC is a fantastic company, but these geopolitical issues are a bit too much. But it does, while that sentiment is shared by some, it goes against the sort of prevailing thought about TSMC, which is that, there's this talk by Raimondo and others in the administration that they need to diversify their supply chain, but this is not something that's going to happen in the next 10, 20, maybe even 30 years. I mean, this is a long-term process. You've got to build those fabs. You got to, get other, resource those semiconductors, and Taiwan is just so well positioned to keep making the ones now, but also to make the advances that are required as those chips keep getting smaller and smaller. So, there is the Buffett comments did spook things a little bit, but really when you look at how quickly the U.S. would be able to mount a serious challenge to TSMC, I mean, that's something that's going to take decades, and you also have the fact that TSMC is going to be darn sure it's going to try to keep its position of advantage and has the money to spend on it.
On the flip side of things, it does feel like China has the advantage right now. Is that fair, or China needs the U.S. and its allies also?
Well, I mean, it really depends on what you mean by advantage. I mean, certainly on microchips, China is behind, and the U.S. strategy in some part has hinged on making sure that China is not able to catch up on the most advanced semiconductors. But there is this perennial problem in foreign policy. How important would Americans think Taiwan would be? Is that a place where the U.S. would want to risk a major global confrontation between two nuclear-armed adversaries versus how important is that to China? I mean, China claims Taiwan. It's a fundamental part of the Communist Party's outlook toward the world, and Taiwan is just off the Chinese coast. So, just when you look at sort of geography, it's something that's going to be much more important to China than the U.S. They obviously find it to be much more central to their foreign policy than the U.S. does. So these are questions that are just going to have to play out in the next months, and hopefully for the U.S. in many years.
All right. Well, so glad that we were able to get some time with you. Nick Wadhams, he's our foreign policy reporter at Bloomberg News, joining us on this Friday on the phone from Washington, D.C. And I do feel like, Maddie, it comes up in so many of our conversations, but I feel like with everything we do, and we go back and forth on what the Fed will do and where inflation is, that is constantly looming in the background.
I found myself searching for the words for the federal government during that because I so deeply wanted to say the Fed. So I've officially become a Bloomberg employee today. But it's so true. And to his point, does the Biden administration have the political will to move in on this as we head towards an election?
Right. All right. That's a really good point, right? Just another issue to think about. All right. You are watching Bloomberg Business Week on this Friday. Carol Master along with Madison Mills, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. Turned out to be a losing week for the S&P 500 index. This week down 0.1%. The Dow this week down 0.2%. NASDAQ as we head into the weekend on the week was down by 0.4%. Those are the weekly numbers. Here's what happened today. We finished in the green. Stocks did a whole lot of nothing for most of the day. Little changed. We had the S&P up 3, a gain there of under 0.1%. The Dow was up 22 points, also up by less than 0.1%, and NASDAQ up 12, a gain of just about 0.1%. So stocks edged higher amid mixed corporate earnings. We've got the 10-year yielding 3.56%, the 2-year 4.17%, spot gold 19.82 the ounce, down 1.1%. West Texas Intermediate crude up 0.5%, 77.76 a barrel. Cannot ignore Bitcoin today, down 3.1%, 27,335 on Bitcoin. The ride-hailing company Lyft is cutting 1,200 or more jobs in a fresh round of layoffs. Lyft shares advanced today by 6.1%. Rival Uber down 2.1%. And that's Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie mentioned price on Bitcoin. It is, we've lost some ground this week. Actually, we've gained some ground, about 8%, forgive me, looking at my wrong screen, but up about 8% on the week, but down about 3% in today's session, as Charlie mentioned. It has definitely, though, been a touch-and-go week for the price of Bitcoin. We've seen the benchmark for crypto currencies dropping more than 7% in the past 2 trading days alone. It is, however, up around 70% this year. So some back and forth, but we've been toying around with that $30,000 mark, I feel like, all week. So let's get to it, because our next guest in our weekly look at crypto, he sees a long bull run for Bitcoin. With his reasoning is Corey Clipston. He is CEO at the Bitcoin savings app Swan Bitcoin. He joins us on the Zoom in LA. Hey, Corey, good to have you here with Maddie and myself. How are you?
I'm well. Thank you so much for having me on.
Well, tell us a little bit about what's been going on, first of all, in terms of your platform. Tell us a little bit of idea in terms of activity, users. Give us an idea of what we're seeing and what it tells you maybe about the Bitcoin space.
Yeah, absolutely. Yeah, I mean, first off, thanks so much for bringing me here. Sure. We're basically a full-fledged financial services firm at this point, though we started off as a Bitcoin savings app, I guess is fair to say, 3 years ago. Volumes are up dramatically, and it basically is perfectly correlated with the onset of the shaky ground that we found some of the banks on about 5 weeks ago. So it was kind of that March 9th, 10th, 11th with Silvergate and Signature and Silicon Valley Bank, and then kind of roiling over to Europe with Credit Suisse. And yeah, you mentioned this thesis that I'm kind of developing, and I think I've been talking about it publicly, but it's actually very much for purposes of running my own company and thinking about pace of hiring and advancing partnerships and entering new markets and rolling out new products and things like that. And basically, it made me turn very aggressive in our growth trajectory and plans. And it's specifically because I think that we have more people than ever in history that are receptive to talking about the merits of Bitcoin and what it's for. And it's cleaning up this false narrative that you saw a lot of in, call it 2020, 2021, maybe even into 2022, of Bitcoin being a near-term inflation hedge, which makes really no sense. It's not about a hedge against, CPI numbers next month or even next year. What it really is an inflation hedge in the sense of monetary debasement. So it is a hedge against the credit fiat-based system and against money printing, that sort of inflation. And I think that's true, but that really is a long-term play.
So because we only have about 6 minutes left here, and forgive me, so if net, your bullish theory on Bitcoin is what?
So specifically, I'm bullish on adoption. So number of people go up. Obviously, long term, I'm very much on record saying I expect $1 million price for Bitcoin by the end of the decade.
But the path that it'll take to get there, I think, is anybody's guess.
Yeah.
What I'm talking about is in the past 3 bull market peaks, there's only been about a 4 to 6 month window where Google search volumes have been off the charts and where a lot of people have been rushing in trying to learn about Bitcoin and get up to speed. And that's, kind of 4 to 6 months at the end of 2013, 2017, 2021.
Yeah.
What I think we have here is something more like maybe 24 months where there's a receptive audience willing to be, as we call it, orange pilled, take the orange pill and get into Bitcoin.
Yeah.
And everybody's interested, and companies are looking at making sure that they have enough Bitcoin on the sideline to be able to pay important vendors and make payroll in the event that their bank runs into trouble, things like that.
Well, I want to talk about the volume thing because I keep hearing you mention different metrics that show that volume is great. We've got a story on the Bloomberg terminal and online about how volume for crypto trading seemed amazing last quarter, but if you isolate just the Bitcoin dollar trade pair, it shows that volume was among the lowest since 2020, and that's of course amid some of the regulatory chatter that's going on. And all of this comes, as I know you're very familiar with, the Binance effect question. Binance ending its zero fee trading. Does that pullback from Binance, which happened just in the month of March, decrease some of that volume to you? And to what extent are you worried about the impact of Binance?
Not worried at all about the impact of any centralized crypto casino, and at least on Bitcoin. And again, I obviously focus on Bitcoin only and don't see much future in the long run for any of the altcoins from Ethereum on down. But yeah, so I guess as far as Bitcoin volumes, if you have zero fee trading and you give beneficial rates and access to market makers so that they can sort of trade contra with favorable terms and access versus your customers, like Binance is rumored to have done over the past few years, you would see some of those volumes fall off as they are forced to cease some of that behavior. So I don't think there's any surprise that volumes would be down.
But even in the Bitcoin dollar trade, we're seeing on that pair volume down. That doesn't concern you?
Not one bit. Yeah, I mean, there's still plenty of liquidity and not much slippage. If you want to make a large buy, you can do TWAP or VWAP and still establish your position with almost no slippage on any major trading venue, including Swan.
So and I just want to make sure I'm understanding. So your thesis has to do with more people maybe trading out of traditional finance and then as a result opting into Bitcoin. Is that fair?
I think it's just more and more people recognizing that, the truth that Bitcoin is the best tool for the job of store of value, which is a giant asset pile conservatively marked at 400 trillion, maybe aggressively at 900 trillion globally.
But how can you say that considering the volatility that we've seen in Bitcoin and how high it went and how hard it fell? How is that to be considered a store of value? And ultimately, you're always going to have a fixed amount, right? So it's, the dynamics of it is not necessarily like, a free trading currency.
So it is a free trading currency, and I think we're confusing a couple of things. I said it's the best tool for store of value. It's going to take, this is the technological revolution on the order of something like steam power or the information revolution or mass production or something like that. So it's going to disrupt all industries over the course of 4 to 8 decades, just like previous technological revolutions. And so when you talk about what your expectations are for where Bitcoin will eventually end up, you have to think about it in terms of what percentage of that asset pile that is currently the store of value asset pile do you think the best tool for the job will eventually take over what time frame? So, if you think that it's going to take 20% of that asset pile, then that would be $80 trillion, and you have to decide, when is it going to take that by? Is it going to be 2050? Is it going to be 2035? And then essentially you just have to right size your bet on that future, but it's going to be extremely volatile on the way. There's absolutely no way it can go in a straight line from $500 billion to say 10 or 20 or $30 trillion market cap in a straight line. It's going to have manias and wild crashes along the way as it grows into its rightful place as more and more people understand what it is.
And one of those crashes obviously being FTX, SBF, regulation is on the way. Do you have concerns at all about people getting bullish on Bitcoin given the risks that we've already seen involved in investing in cryptocurrency when you do have bad actors in the system like an SBF?
Yeah, absolutely. So, I mean, again, the non-Bitcoin crypto space is just rife with scams. Over 99% of those projects are deliberately set up to be pump and dumps. And the remainder that maybe could be honest attempts at building something still in the long run won't need their own microcurrencies. We don't live in a barter system, and monetary networks trend toward one. So if there is some kind of innovation that comes out of the whole DeFi blockchain crypto complex that still gets used by people and businesses in the future, it'll use whatever the major currency is that dominates the monetary space. It'll be dollars and Bitcoin, I think, for the rest of the century, and we'll see what happens with that battle. But that's decades off.
Well,
but yeah, these centralized players, like, they brought this regulation on themselves, right? This was outright fraud and criminality on the part of companies like FTX and Celsius, and it was some flavor of that, maybe more toward terrible risk management when it comes to Genesis, Gemini, BlockFi, Voyager, and some of these other ones that have cratered and lost their clients' money.
And I think, to be fair, we're still trying to figure it all out.
True.
Corey, thank you so much. Really gave us a bunch of stuff to think about. Corey Clipston, he's Chief Executive Officer at Swan Bitcoin. As he said, really a broader financial platform. Initially started as a Bitcoin savings app, but they are certainly offering more stuff. On the phone from LA. All right, let's get back to world and national news. Back to DC we go, our 99.1 newsroom in Washington, and Nancy Lyons. Hey, Nance.
Thanks, Carol. President Biden is announcing a new Office of Environmental Justice on this, the day before Earth Day.
Under this order, environmental justice will become the responsibility of every single federal agency. I mean, every single federal agency.
Biden says today's action is part of a government-wide campaign to use federal programs to address disproportionate pollution and environmental risks that are faced by underprivileged communities. President Biden could launch his re-election campaign as soon as next week. Sources tell Bloomberg he could make a video announcement timed to the anniversary of his last campaign launch, and that would be on Tuesday. The president has brushed aside concerns about his age. He'd be 86 at the end of a second term. Former President Trump is looking to take out Florida Governor Ron DeSantis even before he jumps into the 2024 race. We got more on that from Bloomberg's Nathan Hager.
Governor DeSantis is in the Washington area today. He's attending the Heritage Foundation's 50th anniversary summit. At the same time, former President Trump is in Florida, where he plans to address Republicans tonight. Allies tell Bloomberg the former president will go after the governor on two issues he's proudest of: Florida's economy and his own handling of the COVID pandemic. A Wall Street Journal poll out today shows Trump ahead of DeSantis by 13 percentage points in a hypothetical head-to-head matchup. In Washington, I'm Nathan Hager, Bloomberg Radio.
Tomorrow is National Prescription Drug Take-Back Day. The aim is to keep prescription drugs from being misused. 2/3 of people who misused prescription painkillers received them from a friend or family members. Medications of all kinds will be accepted, no questions asked. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long at Bloomberg, and we begin with a number of developing stories. First of all, we've got word that SVB Financial Group, CFO Daniel Beck and CEO Gregory Becker both resigned earlier in this week. SVP also will be postponing its annual meeting. So again, two key departures. The CFO, the CEO at SVB, they both resigned earlier in the week. Also, SVB Financial postponing its annual meeting. Also getting word that the FAA acting chief, Billy Nolan, is going to depart. That is a report from the Wall Street Journal. Stocks edged higher on this Friday. It was a losing week. On the week, the S&P was down 0.1%, but today gains for stocks amid mixed corporate earnings. Also, traders sifting through the latest data for clues about the outlook for inflation. S&P up 3 points, up 0.1%. The Dow today up 22, also up by 0.1%, and Nasdaq up 12, a gain of 0.1%. 10-year yield 3.56% with the 2-year. 4.17%. Gold down $22 the ounce to $19.82. Drop there of 1.1% for gold. West Texas Intermediate crude up 0.6%. 77.86 a barrel. Bitcoin, a topic we were just talking about, very much in focus today with a decline of 3.1%. 27,323. Lots of tech earnings next week, including Amazon, Microsoft, Alphabet, and Meta Platforms. Amazon reports next Thursday. CEO Andy Jassy has pledged to keep investing in big bets amid cost reductions and job cuts. Nancy Tengler is the Chief Investment Officer of Laffer Tengler Investments.
Yeah, I think now's a really interesting time to look at Amazon. I thought Andy Jassy's shareholder letter was excellent. I think he's being Tim Cooked. Which was, everyone doubted Tim Cook at Apple, and that's when you got a once-in-a-lifetime opportunity to buy it at 9 times earnings.
Tengler was interviewed on Bloomberg Markets with Armand Mentor and Paul Sweeney. Amazon shares today up by 3%. Recapping stocks higher, S&P up 0.1%, and that is a Bloomberg Business Flash.
All right. Thank you so much, Charlie Pellet there. Well, you are listening and watching Bloomberg Business Week on this Friday. In the last 24 hours, the state of Arizona rescinded its approval for 2 new deepwater wells for a controversial Saudi Arabia-owned farm in the desert west of Phoenix. This on the heels of a CBS News report about farms in western Arizona that are growing alfalfa, one of the most water-intensive crops, in an area where there's a shortage of water. CBS noting that some farms are foreign-owned and are shipping the crop to Saudi Arabia, where it is illegal to grow because it takes too much water. Stories about water, access to, lack of, and investing in seem to be everywhere. And our next guest is the CEO of Ecolab. It's a $47 billion market cap company that is a global provider of water, hygiene, and infection prevention solutions for everyone in the food safety, sanitation, and oil and gas industries and more. Ecolab shares, by the way, up nearly 14% year to date. And we welcome the CEO joining us via Zoom from St. Paul, Minnesota, where the company is based. Christophe Beck is here with us. Christophe, nice to have you here with Maddie and myself. I have to say, this CBS report, I'm sure you saw it, or I just feel like there's been a lot of reporting about access to water around the country or water as an investment. What are you seeing when it comes to global water supplies and the conditions of the available water to us all?
Good afternoon, so Carol and Maddie. So great to be with you, and happy Earth Day, a little bit early. It's going to happen tomorrow. Water scarcity is a big issue, and it's one that's getting bigger. Climate change is having most of the impact on water, and water is having most of the impact on climate change as well. When we think about it, so by 2030, it's expected that we will need 40% more water than what nature can replenish. So the problem is big, and it's getting bigger. And we can see, so in places like in California, with the Colorado River drying up as well, getting challenges as well, so to feed big cities like Los Angeles. So the challenge is big, and at the same time for industries, well, there is not only no life without water, but there's no industry without water as well. And the good news is that if we save water, well, we save energy as well at the same time, because we need a bunch of energy to heat water, to cool water, to transport water, to treat water. And that's why dealing well with water ultimately is a very good thing for business and for the earth.
Christoph, you bring up some of the major water sources in the United States, and of course, Michigan comes to mind and the situation in Flint. I wonder to what extent you think that Biden's push on infrastructure and the infrastructure plan could have a positive impact. Does it move the needle enough to kind of satisfy you in terms of lessening the concerns that you have about the status of water infrastructure in the United States?
Well, let's put it that way. It's a good step in the right direction. But interestingly enough, so most of the focus today is on renovating older infrastructure. It's a little bit like if we were to renovate older phone lines when everybody is using cell phones. So we believe in our company, since we serve 1 million of customers around the world and really helping them produce more, better products with less water, that ultimately, so sites, industrial parks, cities will have to become water sufficient. And that means that there should be in a place to reuse and recycle water. So that's why we need even more innovation. Solutions exist, but we need to support companies in order to go in that direction and reuse and recycle water on site, and not just in terms of distribution industry for business and for people. And we realized that 150 companies worldwide impact a third of the world water consumption. So we came together with the United Nations and saying we will create the Water Resilience Coalition, getting those 150 companies together in order to reach 3 objectives. The first one is all of us to get to net zero, which means reusing all the water that we are using. Second, it's really to protect 100 basins around the world that are supporting 3 billion people's lives. And the third is to provide access to 300 million people who do not have access to clean water today. And we've partnered with many companies. Microsoft was one of the founders together with us. We had Cargill, we had Diageo, we had Starbucks as well. A lot of companies have joined. And one of the partners has been Water.org, a remarkable organization, which is not a philanthropic organization. It's investments in order to provide water for people who will pay for it, but it's less expensive than to go and get water in those places where there is no access. So we've helped fund that organization. So far, almost 4 billion have been mobilized to provide access to 52 million people. So the Water Access Fund you just mentioned is one additional step in that direction.
Christoph, I have to say, 20 years ago, 15 years ago, I wanted to do this documentary, and I'm like, guys, water, it's the next commodity we're all going to be fighting over. And everybody's like, oh, come on, we've all been talking about that for years. We're going to have plenty of water. It's just like a non-event. Here we are. What has changed maybe in the last 5 to 10 years when it comes to global water supplies?
The things that have changed are good things. We are much more people on the planet. We will be 2-3 billion more in the decades to come. We've been growing as well. The diets have changed as well, moving from more cell-based to more proteins, which means meat. And to get meat, well, you need to feed the animals as well. You need more water for it as well. So it's driven by the right things, except that human beings and industries are thinking in a linear way. You take the water, you use it, you dump it. We should more do it like nature does, which is using it in a closed circle. It goes to the cloud, it rains, it comes back, you use it, and you work in a cycle. So good changes, but we need to rethink the way we manage water in order to keep growing.
Amen. Yeah, and here we are one day before Earth Day, and really appreciate you and having this conversation. Christoph Beck, thank you so much. Chief Executive Officer of the publicly held Ecolab, as we said, a $47 billion market cap company, but really talking about initiatives and companies banding together when it comes to water. Joining us via Zoom from St. Paul, Minnesota. Yeah, we've had a lot of great conversations this week. Tomorrow is Earth Day, everybody, so
Yay, Earth Day.
Yeah, and if you missed any of the conversations, check out our podcast feed talking about agriculture, water, just our environment. We got to take care of Mother Earth.
Yeah, it's critical. It's the most important resource we've got.
Absolutely. All right, this is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet, SVB Financial Group. The bankrupt former owner of Silicon Valley Bank says its CEO and chief financial officer have both resigned. More than a month after the lender collapsed into receivership, the company is also delaying its annual meeting. The ride-hailing company Lyft is laying off 1,200 or more jobs in a fresh round of cuts. The latest reductions could affect 30% or more of Lyft's more than 4,000 employees. Today we had Lyft shares rallying on that news. Lyft up today by 6.1%. Uber, though, headed the other direction, down by 2.1%. Procter & Gamble raising its sales projection for the fiscal year ending in June. And with more on that story, here's Bloomberg's Kimberly Adams.
Charlie, the maker of Bounty paper towels and Herbal Essences shampoos, cites higher prices and a slight increase in demand for some of its products. P&G says organic sales, which exclude currency fluctuations, should grow about 6% from the prior year, up from its previous forecast of as much as 5%. Yet P&G did not budge on its profit outlook, despite easing costs, reiterating its expectation that earnings per share will be at the lower end of a $5.81 to $6.04 range. The outlook and quarterly results outpaced expectations in key metrics, highlighting that the U.S. economic slowdown appears to be relatively contained, even as elevated inflation restricts household spending. Charlie?
And that's Kimberly Adams reporting. Shares of Procter & Gamble today up 3.5%. Those are some of the company stories we're following this hour. I'm Charlie Pelleton. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
You're listening to Madison Mills here with Carol Masser on this Friday. We're going to have more Business Week for you ahead, but first, let's get a check on the news with Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Hey, Madison. President Biden on this eve of Earth Day is moving to ensure the benefits of the increased climate change spending goes to areas of the country that are hardest hit by pollution.
The president said the goal would be to target 40% of these funds to disadvantaged towns.
People living near factories seeing the paint on their cars literally peel off because the air was so corrosive. Landfills and garbage incinerators located right in the middle of communities. Drinking water contaminated. This kind of inequity and injustice goes against everything we stand for as a nation, but it continues to exist.
The president said he's creating a new Office of Environmental Justice to superintend mitigation strategies and to spark research into the effects of pollution on health. In Washington, Irv Chapman, Bloomberg Radio.
Well, it's certainly not what Ukraine wants to hear, but at today's meeting of the Ukraine Contact Group, U.S. Defense Secretary Lloyd Austin said the U.S. is still not looking at sending jets into the battle.
Right now, what we all believe is what Ukraine needs most urgently is ground-based air defense capability. That is what has enabled them to prevent the Russian air forces from having a meaningful impact in this fight.
Austin says 21 Abrams M1A1 tanks will be arriving in Germany next month, with roughly 250 Ukrainian troops expected to begin training on them. Ukrainian defense advisor Yuri Sak told Bloomberg yesterday the current MiG jets that the Ukrainians are flying are no match for the newer Russian MiGs that they're facing. Two rival generals in Sudan are facing international pressure to end a conflict that's threatening to tip the country into a full-blown civil war. The African Union and representatives from the U.S., UK, China, and Russia have all called for an immediate ceasefire. The World Health Organization says more than 400 people have been killed, 3,500 others wounded since the fighting broke out 6 days ago. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Madison Mills, live in our Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. Hey, our conversation just off of our last guest talking about water in the United States. We were talking with Ecolab CEO, and it's interesting. There's a lot going on with water as an investment, access to certainly around the countries. We've seen climate change either drop a lot in certain parts of the country, or we've seen extreme droughts. California, the Midwest, we've certainly seen it. And in keeping with that, there's a story by our Samantha Hawkins of our Bloomberg Law team, and it talks about the Biden administration's new Waters of the U.S. rule is being temporarily halted in Kentucky while the Sixth Circuit considers state and business groups' appeal of a lower court's dismissal of their challenge. So there's a lot of legalese going on here. But the three-judge panel on the U.S. Court of Appeals for the Sixth Circuit yesterday becoming the third federal court to halt implementation of the WOTUS rule, which is, as we said, the Waters of the U.S. rule, which defines the scope of waters protected under the Clean Water Act. And I'm just looking at it. So basically, it defines which streams and wetlands are protected by the Clean Water Act. A narrow definition would leave many wetlands and streams subject to state jurisdiction, which could constrain pollution